The live intraday trading price for Plug Power stands at $3.19, showing a downward market movement of 10.65% in today's session on June 9, 2026. While a double-digit drop normally sends panic through the retail trading community, the institutional reality behind this sudden shift tells a far more calculated story. Beneath the surface of today's sell-off lies a strategic balance sheet adjustment that changed the liquidity profile of the business, proving that what looks like a rout on a simple smartphone chart is often a controlled restructuring of capital behind closed doors. The prevailing market narrative surrounding clean energy equities, specifically alternative fuel developers, has been defined by extreme skepticism. Investors have grown tired of dilution, delayed projects, and cash burn profiles that seem to stretch out into perpetuity. Because of this, when a company experiences a sharp drop, the immediate reaction on public forums and standard tracking platforms is that the sky is falling. The common belief is that the business is rapidly running out of runway. However, the contrarian view reveals that management has actually begun clearing their near-term hurdle rate by executing a structural sale of federal investment tax credits from their major St. Gabriel production facility. This moves the operational reality away from pure equity dilution and toward asset monetization. It is an intricate setup where the superficial numbers look troubling, but the structural foundations are shifting in ways that passive observers miss entirely. Analyzing recent stock movement requires examining the heavy trading volumes that accompanied this downward swing. Today's volume spiked well past 45 million shares, a massive acceleration compared to the typical base run activity. This level of liquidity indicates that large-scale institutional blocks are actively shifting positions. When look at the momentum across the broader market, highly speculative assets are facing intense macroeconomic pressure from persistent capital costs. This environment forces a separation between companies with actual physical infrastructure and those that exist merely as conceptual business plans. For Plug Power, the intraday low touched $3.17 against a high of $3.34, proving that the sellers held dominant control from the opening bell. This type of price action tests the resolve of self-investing enthusiasts who manage their own portfolios on an individual brokerage or through a traditional online investing platform. This level of volatility underscores the critical difference between automated allocation and active management. Investors relying solely on standard setups such as a Schwab Intelligent Portfolios account or basic automated intelligent portfolio options often find themselves exposed to these sudden sector-wide re-ratings without a built-in hedge. When a high-beta industrial asset shifts 10% in a single session, it highlights the necessity of human oversight in any online investment strategy. Mainstream platforms like a standard Robinhood app or basic online investing portals provide immediate access to fractional shares and quick executions, but they do not protect an account from the underlying reality of corporate cash burn. It requires a deeper technical look to understand whether a drop is a death spiral or a temporary repricing event. To put this into perspective, look at how the stock has behaved over the broader macro timeline. The asset has carved out a wide 52-week trading range between a low of 99 cents and a high of $4.58. This indicates that the equity behaves less like a stable utility and more like an option contract on the future of alternative industrial infrastructure. Institutional accumulation often happens when retail sentiment reaches its absolute nadir, which typically occurs right around the $3 threshold. When trading platforms see massive spikes in volume at these specific price levels, it usually signifies that larger funds are absorbing the shares dropped by panicked retail hands. Comment below how many shares of Plug Power you currently hold in your portfolio right now, or if you are avoiding the sector entirely. Understanding the mechanics of this stock requires comparing it to how major tech components behave. When people look at premium assets like Tesla stock, Apple stock, or Nvidia stock, they are evaluating companies with massive balance sheet protection and mature free cash flow generation. Those equities trade on multiples of actual earnings or near-term projected growth. Conversely, alternative industrial infrastructure stocks trade almost exclusively on liquidity metrics and the cost of debt. If a retail trader tries to analyze an industrial hydrogen producer using the same fundamental metrics they use for a dominant semiconductor business, the comparison fails immediately. The risk profiles are entirely distinct, which is why a major drawdown in a speculative clean energy stock requires a completely separate analytical framework. This distinction becomes clear when observing how capital moves across various execution venues. A retail trader using a Robinhood stock trading setup or managing small positions via Robinhood investments might see the daily loss and execute a rapid sell order to protect capital. Meanwhile, a professional desk executing orders through a highly sophisticated interactive brokers trading setup or utilizing an institutional interactive brokers platform is looking at the long-term cost structure. They analyze interactive brokers' fees and leverage specific interactive brokers' account types to build short positions or establish protective options collars. The difference in execution strategy directly shapes how these daily price swings manifest in the public market data. Let us step back and look at the fundamental architecture of what Plug Power actually does as a business entity. The company operates a fully integrated green hydrogen ecosystem, positioning itself as a manufacturer of fuel cell systems, electrolyzers, and the physical infrastructure required to store and dispense clean fuel. Their business model relies on converting massive amounts of electrical energy into clean liquid fuel that can power industrial equipment, material handling fleets, and eventually heavy-duty commercial transport. Historically, their core revenue generator has been the material handling sector, providing clean propulsion systems for forklifts inside massive distribution hubs operated by global retail giants. The past financial performance of the firm explains why the current market narrative is so intensely strained.
For years, the company operated at a negative gross margin, meaning it cost more to produce and deliver the fuel than customers were paying for it. This structurally flawed pricing model was driven by high legacy energy costs and delayed build-outs of their internal production facilities. The March 2026 financial metrics revealed a revenue printing at $163.51 million, contrasted against a total cost of revenue at $192.93 million. This resulted in an ongoing operating income deficit of $103.93 million, with net income closing at a loss of $245.30 million for the single quarter. These legacy reports highlight exactly why the expectations of the market have been so remarkably low. However, the reality of the business model is undergoing a massive operational shift that most retail platforms fail to articulate. Management has been systematically working to transition away from high-cost third-party fuel procurement towards self-produced, vertically integrated liquid fuel generation. The step down in cost structure at facilities like their Georgia and St. Gabriel plants is designed to flip their gross margins from negative to positive over the coming multi-year window. The company's long-term internal guidance points towards achieving sustainable profitability by 2028, an objective that relies entirely on scaling their internal liquid production capacity and reducing their reliance on external supply chains. Navigating this complex landscape requires solid investment help to avoid the psychological traps of catching a falling knife. Many market participants utilize legacy institutions like Fidelity Investments to manage their core wealth through diversified vehicles such as Fidelity ETFs or established Fidelity mutual funds. Utilizing a professional Fidelity brokerage or taking advantage of specialized Fidelity wealth management advisory services allows an investor to isolate high-risk speculative plays from their core retirement capital. Managing speculative clean energy bets inside traditional Fidelity IRAs or tracking them via the Fidelity mobile app requires a strict risk mitigation strategy, ensuring that a single corporate restructuring event does not compromise an entire portfolio. The tension between expectation and reality will ultimately decide the trajectory of this stock. The general market expectation is that the business will continue to suffer from dilutive capital raises and operational delays, keeping the equity permanently pinned to single-digit valuations. The underlying reality, however, is that if their internal production facilities hit their optimized run rates, the cost per kilogram of produced fuel will fall drastically. This margin inflection is the core catalyst that traditional analyst desks are watching. If the company proves it can produce liquid fuel efficiently, the financial reality will radically exceed the market's currently depressed expectations, triggering a massive short squeeze and institutional re-rating. Looking ahead, several clear catalysts and critical risks define the future outlook for the stock. On the positive side, the closing of federal tax credit sales proves that the business can generate non-dilutive liquidity from its physical assets. Furthermore, any progressive policy developments regarding domestic production subsidies will act as an immediate tailwind for their domestic manufacturing facilities. Conversely, the risks remain stark. If execution delays persist at their new generation hubs, or if industrial adoption of fuel cell systems slows down due to alternative battery technologies, the company will be forced back to the public markets for additional equity financing, further diluting current stakeholders. For active traders navigating these turbulent sessions, the choice of execution infrastructure matters immensely. Those executing trades through the fast-paced Robinhood crypto and equity options desk are seeking immediate short-term alpha on these double-digit swings. Meanwhile, investors utilizing a comprehensive SoFi active investing approach or building long-term blocks through a sophisticated SoFi trading platform are trying to position themselves ahead of a multi-year macroeconomic shift. No matter which tool you prefer, whether it is the simplicity of the SoFi robo-advisor or the precise execution of specialized investing sites, the core requirement remains exactly the same. You must look past the immediate intraday place action and understand the structural adjustments happening deep within the corporate balance sheet. To summarize the central insights of today's deep dive, Plug Power's immediate intraday drop to $3.19 reflects a severe divergence between short-term market expectations and long-term operational reality. The broader market viewed the sharp decline as another symptom of speculative clean energy distress, whereas a closer structural inspection reveals an intentional effort to unlock liquid capital through asset monetization and facility tax credits. The historical reality of negative margins and significant quarterly losses continues to weigh heavily on investor sentiment, but the ongoing pivot toward vertical integration and self-produced green fuel creates a distinct contrarian setup. The future of the company hinges entirely on whether operational execution can outpace cash burn before their 2028 profitability targets. This structural tension between superficial panic and internal corporate realignment is exactly what separates reactive retail trading from disciplined institutional allocation. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Ball and bag. Don't forget to like, comment, and share this video to support the channel. Heart emoji.